Hey, how's it going, everyone? Today we're going to be taking a deeper look at Realty Income Corporation, ticker symbol O. This is one of the more popular dividend stocks because it is a monthly paying dividend REIT. In this video, we are going to be looking at the intangibles, the finances, and run some valuation models to determine if I had $500, would I buy Realty Income Corporation? For simplicity's sakes, am I allowed to just call it O from now on? Anyways, let me just give a quick rundown of what the company is or does. So, Realty Income, otherwise known as O, owns properties across different industries and allows other businesses to rent those buildings to run their operations. Here's an example of some of their clients. Think like FedEx, Dollar Tree, 7-Eleven. Realty Income collects a monthly rent from those businesses, and you, as a shareholder, get a piece of the pie as a result in the form of a dividend. This is a company that is admired and adored by the dividend community, especially on Reddit. Now, the reason why I wanted to make this video is that O has been taking a beating lately. If we are to zoom out, 52 weeks ago, it was trading at about $65 per share, reaching a high of about $68. However, it has been on a downward turn as the federal funds rate has been increasing consistently every 2 to 3 months. And the reason why this is an important call out is because certain people believe that the interest rates are going to stay high for a while. And as a result, they would rather pile their money into safer investments like treasuries or bonds instead of O. So if you buy O at its current trading price of $50 roughly, that dividend yield is 6%. On the flip side, those treasury notes that you buy, they're going to return back to where they were pre-pandemic. So it's a game of long-term strategy versus short-term planning. One is safer than the other, but realistically, O is a mature company that doesn't seem speculative or risky to me. I think of risky or speculative as those startup companies going through the pains of growing and desperate to get capital and tackling on mad amounts of debt in order to just stay alive. But along with that, O also just announced in their recent earnings that they are going to be acquiring Spirit Realty Capital, otherwise known as ticker symbol SRC, one of their competitors in the REIT space, by issuing new shares. And some investors did not like that, but we will touch upon that a little later in this video. We're going to circle back to that. And I promise, once we are done looking at the metrics and intangibles, we are going to be running some valuation models to figure out the intrinsic value for O. The name of this channel is Dividend Compounders with Cheese. And so I am focused on highlighting and making content about dividend compounders. So let's check out their dividend over the years and share price while we are at it. All right, so let's zoom back and take a look at where O was trading at back in November 2001. I believe at the time I was in 4th grade. But that's neither here or there. The stock price was trading at about $4.35 per share. What makes O a dividend compounder? Well, let's see what happened even just like 5 years later. In 2006, it doubled in its value. This is right before the Great Recession, mind you. Let's go forward a little bit more and see what happened. During the Great Recession, oh yeah, the stock price did come back down. Not by much though. All right, so let's take a look at what happened to the stock immediately following the Great Recession. It looks like it rebounded at a pretty rapid rate, and it just grew year over year consistently. Obviously, there are times when it hits a high, and it comes back down, but consistently, every single time that it hits that high, after it goes low, it rebounds and then it reaches a new high. So Realty Income Corporation definitely hits the green lights for a compounding stock. But what about its dividends? So right now, it's currently at a 6% dividend yield, meaning for every share that you own at about $50, you get paid $3.07 per year. But here is the catch. They are a monthly paying dividend REIT, meaning every single month consistently, as you can see by their history, you will be paid a dividend. So let's take a look at what their dividends look like back in, 1999. They paid 8 cents per share every single month. And then if you fast forward, that dividend has been consistently growing throughout the years. This track record is actually impressive because I think about some of the other dividend favorite stocks throughout the years. They do not hesitate to cut the dividend altogether when things get a little rough. However, for Realty Income Corporation, even when they hit a rough patch, they might have to reduce their dividend temporarily, but it does not mean that they cut the dividend like Disney did or AT&T. Just two companies that come to mind. If you're anything like me, you do appreciate visuals and graphs, but you also like to see the numbers. So when we take a look at the dividend history, look at how far back you could just zoom and you could just see how consistent they have been paying their dividend every single month. And an interesting call out here is that even through the Great Recession, O was able to increase or be consistent with their dividend payouts. They did not pause, freeze, or cut. So 14 cents back then, zoom back out. Oh my goodness, this is exactly what you want to see in a dividend paying stock. Phenomenal, absolutely phenomenal. With that said, the next thing that I like to take a look at is besides the dividend yield and the annual dividend, what's really important to me is the payout ratio. But this is an important call out. Because O is a REIT, for that we are going to use the AFFO, which is the adjusted funds from operations, and determine the payout ratio from that. So when you calculate the payout ratio from GAAP earnings, this is alarming, right? 151%. This is not accurate. And that's because REITs are special in that they're mandated to pay 90% of its taxable income to the shareholders. And so that's why it turns out like this when you churn the numbers using GAAP. But when we do the AFFO payout ratio, then we come to a conclusion of a 47.7% payout ratio, which seems healthy. Also, this is a really important time for me to call out that REIT dividends are also taxed as ordinary income instead of qualified income. The next metric that I like to evaluate is to look at the historical PE ratio. But since O is a REIT, and with REITs, you cannot and you should not evaluate it with the PE ratio. But instead, we are going to measure it by utilizing the AFFO once again, because the AFFO takes into consideration the depreciation of their properties and reoccurring overhead costs, like maintenance fees, to figure out how well their operations are doing and their ability to pay dividends going forward. To make this as simple as possible, when you think of AFFO in regards to a REIT, think of it as the free cash flow. Hopefully that makes sense. So in lieu of the PE ratio, we're looking at the AFFO. And right now the price to the AFFO is 12.7. And just like how we appreciate when a company is able to grow its free cash flow consistently, look at Realty Income Corporation's AFFO year over year. This is a phenomenal business result that you want to see as an investor of a REIT. Now, if we were to zoom out and take a look at the AFFO for the past decade or so, look at its growth rate year over year. From 2014 onwards, it literally grows its AFFO by double digits consistently. This is amazing. And this is something that most finance YouTubers are not talking about. They don't go into the data and look at the AFFO. This is the most important thing. And that's why on this channel, we are going to do things a little differently. We're going to look at everything. So alongside with Jerome Powell's current reaction to how the inflation is panning out and the federal funds rate increasing, that's one of the variables as to why Realty Income Corporation is dropping. However, as of recently in the past week or so, another reason why they're dropping is because they did announce that they are going to buy out Spirit Realty Capital. So let's take a look at their portfolio and see if it is a wise investment. All right, so SRC, headquartered in Dallas, Texas, premier net lease REIT, investing primarily in single tenant, operationally essential. This is basically the exact same thing and the exact same business that O is in. I see why they bought out their competition. Anyways, their portfolio As of September 30th, 2023, they have 2,000 properties across 49 states and 37 industries. So it's a very diverse portfolio and mix that they have. 99.6% occupation rate. That is actually really good and impressive. 338 different companies. This is good. Let's see how it breaks down. It looks like Spirit has their hand in almost every single industry that you can think of. Car washes, convenience stores, movie theaters, manufacturing, discretionary retail, dealerships, sporting goods, non-discretionary, dollar stores, pet stores, country clubs, hotels, office spaces. This is pretty good. So who are Spirit's top 10 tenants? This is important because this company is being absorbed by Income Realty. So we want to make sure, is this company actually a wise investment, right? So let's think about it. Who are some of the clients? Golf clubs, Lifetime Fitness, BJ's, Dave and Buster's, Circle K, Dollar Tree, Home Depot. So far, so good. I think this is not a bad investment because when you look at the 99.6% occupation rate and also the type of businesses that their clients are, I don't know. When I look at this, I feel like it's not that bad in comparison to something like Vici that is almost all in the adult entertainment space, like casinos and whatnot. I feel like that type of spending from the consumers is bougie and super optional. Whereas when we think about things like convenience stores, quick service restaurants, and stuff like this, the everyday person is going to continue to utilize and be a customer to. But to a casino, I feel like you're going to have a big trip to Las Vegas when things are going well. Personally, I think Spirit is looking like a great REIT, and I think Income has actually made a wise decision, in my personal opinion. I might be missing something, and if I am, please let me know. And circling back to their most recent earnings report, let's take a look at their third quarter highlights. So the first bullet point, they are increasing their AFFO per share guidance. Phenomenal. They have a 98.8% occupation rate, which, by the way, I think Spirit beats them on, effective October 1st, 2023. The Cineworld bankruptcy. This one is a call out to me because Cineworld is one of O's clients and they did go through a bankruptcy. So how will that affect their ability to pay rent? So let's take a look at what happened. Cineworld resolution summary. All right, so it looks like the too long didn't read this is O's damage control and saying that, hey, even though Cineworld declared bankruptcy, this is not going to affect our long-term vision and our bottom line. We are still going to be okay. The next metric that I like to look at to evaluate a stock is the shares outstanding year over year to figure out if the company is issuing more stocks and diluting the shareholders, etc. With normal stocks, dilution is a concern. But with REITs, it is their primary method of expanding and buying new property, which in turn allows for the earnings to grow and the dividends to get bigger. If they are under management that is competent and prioritizes the shareholders, of course. Because I understand that's how REITs grow, I'm not going to take into consideration the shares outstanding. Anyways, I wanted to highlight some other slides from the earnings presentation. So I really like this slide right here. Why invest in Realty Income now? They lay out 4 of their biggest arguments. Number 1 is the proven track record of returns. This cannot be understated enough. This is one of the primary reasons why you should feel happy or be able to sleep safely at night, knowing about their history and their track record of success. However, this is really important. Past performance is not indicative of future gains. So just because they have a proven record, it does not mean that it's going to continue to be that way. The management team might go haywire and everything might fall apart. That is a possibility. But to me, I feel like that's highly unlikely. Their second point, consolidator in the fragmented net lease sector. They just acquired Spirit. So that's going to even make their foothold in that industry even more of an economic moat. That's good. Their balance sheet. Yes, this is a very strong call out. Positioned for long-term value. Yes, their growth rate targets are pretty conservative and consistent, so you can rely on that. This right here, diversified revenue mix, their portfolio is a good and a bad thing. As an investor of Realty Income Corporation, these 4 reasons make me feel a little happier about my decision. But anyways, moving on down to slide 15. It's the slide to emphasize how consistent they are in their track record. 13.4% compound annual total return year over year. I mean, when we look at the share price, that is pretty evident, right? They have just been consistently growing year over year. Sometimes, yes, they do drop, but they do end up rebounding and then reaching a new high. This one right here, consistently increasing dividends, but also consistently paying them out. They are a dividend aristocrat. The compound annual growth rate for the dividends is 4.3%, which is traditionally higher than the normal rate of inflation. Let's slide on down to page 18. The risk reward factor against their volatility, against all S&P 500 stocks and companies, they are one of the more safer options. And against other S&P 500 REITs, they are the second most safe REIT. Let's go to slide 19, stability versus the other S&P 500 REITs. So the portfolio occupancy rate for O, they are the orange one on the left, a 98.2% is their historical occupation rate. Their competitors are sitting at a 94.2%. Their lowest in history was at a 96.6% occupation rate. Occupation rate basically means, does a business currently have their operations running in one of O's properties, and are they paying rent? Their competitors' lowest year-end, 91.9%. And then, of course, their dividend growth rate, 4.3%, versus their competitors that have a 3.1% CAGR. And then, of course, this is the boast about their credit rating, which I believe is important because it shows your ability to pay back liabilities just in case things hit the fan. Does anyone know who this is? Who is the REIT that actually has the highest credit rating? I'm actually curious about that one. But this is where O is at versus their competition. All right, and the last slide that I wanted to look at is on 26, the diversified high quality portfolio. Who exactly are the clients for O? We have businesses such as Dollar General, 7-Eleven, FedEx. These, I believe, are European. LA Fitness, which, by the way, I am a gym rat, and I can tell you that LA Fitness is one of the more bougie types of gyms. It is just jam-packed with amenities and resources available to you. I actually can't afford LA Fitness. Moving down along, 11.4% of their clients are in the grocery store space. These are all looking pretty good. In terms of location, 12.3% of their properties are based in the UK, and Texas is 10.1%. And I remember that SRC is based in Dallas, Texas. 15.3% of their properties are there. So this value for Texas should jump up once the acquisition is complete. One thing that I like to see here, as someone who likes to browse Zillow.com when I'm bored at home properties, these states are all densely populated. I'm actually a fan that Realty Income is not conducting a majority of their business in low populated states such as Wyoming. Because from my understanding of business operations, the higher the density, the more population there is, the higher foot traffic, which allows these businesses to thrive, which allows them to pay their rent on time to Realty Income Corporation. Alrighty, so the next thing that we're going to be looking at before doing the valuation models is the technical indicators. And we're just going to do a very quick analysis on the stock price movement to figure a few things out. What I'm looking at primarily is the stock trading pattern. Is it moving upwards? Is it sliding downwards? Is there a line of support, a line of resistance? And most importantly, the current relative strength index. Traditionally, an RSI above 70 means that the stock is overbought. Everyone's piling in, it's hyped. Below 30 means that the stock has been oversold, and it might be a good time to buy. This is one of those instances where you want to remember what Warren Buffett said. Be greedy when others are fearful, and fearful when others are greedy. So let's go ahead and take a look at O's technical indicators for the past 52 weeks. So it looks like it was trading sideways for a majority of the past 48 weeks or so. And as it transitioned from July to August, the RSI was sitting at about a 70, which means that a lot of people were piling into O at the time. And then when the federal funds rate did not seem like it was going to go down, but instead stay flat or with the possibility of increasing, the macro environment did make REITs suffer and fall. So as you can see, the sell-off started to happen and the RSI was roughly at about a 36 at the beginning of August. Fast forward, with no improvements in sight for inflation, the sell-off did continue where it reached the low of a 13.7 RSI back in September. My goodness gracious. But it does look like there is a line of support for the majority of the time, except on October 30th, the day before Halloween. It looks like people knew about the Spirit Realty Capital acquisition, and that's when the sell-off pushed the stock down to $45 per share. My goodness. So as you can see, prior to the pandemic, the popularity of O, the RSI was always above a 50 to roughly about a 70 or so, right? And then when the pandemic hit, the sell-off pushed the stock down to a 24 RSI, signifying that it had been oversold. But with that said, it does look like investors are seeing that this is a really good buying opportunity because as of recently, the RSI has reached 54.23. So it does look like people are buying back into the stock because they do realize this stock right now is super undervalued. But before I can make statements like that, let's go ahead and run some valuation models and then compare that to the Wall Street analyst price target to see if it truly is undervalued. Hey, you made it to the valuation portion of the video. So we're going to run 3 different valuations: the AFFO multiples, the discounted cash flow valuation, and the dividend discount model valuation to reach an intrinsic value for Income Realty Corporation. So basically with the multiples valuation, you take similar companies in the similar industry as the company that you are evaluating, you take their PE ratio, but in this case and example, we are going to take their price to AFFO multiple to determine an intrinsic value for Realty Income Corporation. So based on these different REITs, the intrinsic value for O, the multiples valuation, is $50.94, which is scary similar to its current trading price. But this does not tell the whole picture. So that's why we are going to move along to the next valuation, the discounted cash flow analysis model. Essentially, we are looking at the year-over-year free cash flow growth to determine an intrinsic value. So it does look like the free cash flow is growing at a very healthy rate. Sometimes it's single digits, sometimes it's double digits, sometimes it's almost 3 digits. My goodness gracious. Year over year, O is growing their free cash flow at an average of 27.57%, almost 28%. The analysts predict that O is going to be able to grow at a rate of 22.6%. However, I do like to play it safe and run conservative numbers. That way, I'm not trying to hype myself up. And that's because of my risk profile. I like to play it safe than sorry. So I decided to divide that by 2. So we're going to plug that in, take a look at some balance sheet numbers, which is going to spit out a discounted cash flow price per share of $85.42 per share. And finally, we are going to run the dividend discount model valuation to figure out O's intrinsic value according to their dividend payouts and the growth rate of those dividends. So in 2019, they paid 21 cents per share every month. Not quarter, not every 3 months, but every month. Annually, that was $2.52 per share. Fast forward today, O is paying 25 cents per share every single month. Annually, that is $3 per share, which gives us an average dividend growth rate of 4.46%. So from that average dividend growth rate, that gives us an intrinsic value, according to the DDM model, $88.53 per share. So this is going to be the conclusion. What is the intrinsic value for Income Realty Corporation? Drum roll, please. So the discounted cash flow said $85 per share. The DDM model said $88 per share. The multiples valuation said $50. That gives us an intrinsic value for O $74.75. Is that within the past 52-week trading range? Just outside of it. It looks like it did reach a high of $68.85. But hey, according to our math and calculations, we think it's worth more than that. But what does Wall Street have to say about Income Realty? It looks like the low forecast is sitting at $48 per share. That's pretty bearish. The high is sitting at $72. The average is $60.90. So it looks like we are a little bit more optimistic than Wall Street, even though we used very conservative numbers to plug into the formulas. The current trading price for O is sitting at around $50, plus or minus $1 or $2. So with a margin of safety applied, let's see what our potential buying price would be. With a 10% margin of safety, the acceptable buy price would be at $67. Let's say 10% is not enough of a buffer. So let's say 20%. With a 20% margin of safety, your acceptable buy price is $59. But what is the margin of safety that you get if you buy it at its current trading price of about $50, $51? Are we going to say it's 25%? Nope, you get more than that. Is it 30%? Do you get a 30% margin of safety? Yes, you get roughly a 30% margin of safety at its current trading price. So for those of you who are looking to buy O with a 30% margin of safety, the acceptable buy price is $52.32. And here's the thing. Don't just think of this as buying a stock and hoping that it goes up. My mentality is the belief that I am buying into this company, into Income Realty Corporation. It's a business that has real operations with a real service and product. And I am becoming a part owner of it. I'm trusting the middle management and the executive team to run the company on my behalf. Because I already own shares of O, what I'm going to do is continue dollar cost averaging into O stock as it stays below its intrinsic value. And that's because I have a very long investing horizon, right? And it's better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. And when I look at O, and I looked at the financials, the data, and the forecast, and the acquisition of Spirit Realty Capital, I think that the hype is warranted. I think it's good. It's a good company. Please do your own due diligence and research to figure out whether or not you like the company and the stock, of course. And if I had $500 to answer the original question, I'm going to continue to dollar cost average as it stays below that $52 to $55 range. Just buy a share or two, just consistently. Because even if the stock does sink a little bit, it's going to continue to pay that monthly dividend as it looks to rebound in the future. So let me know your thoughts, because I actually enjoy hearing contrarian beliefs and thought processes to my own thinking, so that I'm not just sitting in an echo chamber or having confirmation bias. If O is not a good investment, please let me know, and please do share your call out. With that said, this has been Dividend Compounders with Cheese. I'm signing out. Stay safe, and I will talk to you next time.